Today is Monday, September 25th, and this is the ADM Investor Services Monday Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADMIS, and Alan Bush, ADMIS's Senior Financial Economist. Steve, let's start with the grains today. What is the latest on the U.S. corn and soybean harvest yields versus the USDA, and how is the harvest progress?
Right now we're guessing that the bean harvest is about 14% done and corn harvest is about 17% done. And you get all these little emails from harvest results, and for the most part they're like in Illinois, Iowa, Missouri, and the farmers are saying that both corn and bean yields are better than expected, which is remarkable given how little rain we've had, and that they probably justify the USDA's September numbers. So that puts a lot of uncertainty in the October 12th crop report.
Is the U.S. farmer selling?
Right now he's just delivering on contracts. I think the perception is where soybean prices are, as the harvest progresses, he will sell soybeans, and the basis levels has been breaking the last couple of days. He's going to try to store as much corn as he can because the prices are below break even.
Can you speak to the current managed fund position in the grains?
Well, the funds have built a long position in beans. It's not real big, but it's all because of the Chinese buying that they've come in recently. They are short a lot of corn and a lot of wheat, and I think that's because of the perception that global stocks are high and export demand from the U.S. is going to be low. They also are long a lot of soybean oil because of the particulars in the anti-dumping laws that could increase domestic soybean oil demand.
What are the technical signals suggesting right now in the grain complex?
It looks like a trading range, maybe a little bit wider in beans than in corn and wheat. I think in beans the market has underlying support from the demand, and over the top is just there's too much supply. We're watching Brazil-Argentina weather pretty closely because it's dry in Brazil and wet in Argentina, and that might boost beans over the $10 level. Corn just can't rally because there's just too much corn in the U.S., and yields could be right in line with what the USDA is saying, but it can't break very much because the farmer's not selling. And for wheat, there's just too much wheat in the world, and it just can't bounce off the season lows.
Speaking of weather, you mentioned South America. Are there any other weather hotspots right now or issues?
People are trying to focus on some dryness in Russia and the Ukraine and dryness in Australia. The thing about South America is that it looks like after the 1st of October, Brazil's going to start seeing normal monsoon type rains, which is perfect for their crops.
We have a report this Friday. Any predictions? What is the market looking for?
Well, we all know that USDA's reports are volatile, and the managed funds and also the machines are going to be looking for a corn, which is a carryout number, of 2.3 billion bushels, beans somewhere around 340 million bushels, and this will be a September 1 stocks for wheat, the first quarter of wheat usage. The number might be around 2.2 billion bushels versus 2.5 last year, and then they'll come out with a final wheat crop number. It should be around 1.7 billion bushels, which is close to their number. Some people are a little bit below that, thinking that maybe the spring wheat crop or the winter wheat crop might be a little smaller than what the USDA is saying. So in general, you can have any kind of surprise you want. I mean, if the government undershoots the stocks numbers, we could rally, and if they overshoot it, we could break.
Steve, even if the yields come in a little bit lower than what the USDA said, the supply would suggest that that's not going to have a major impact on the market. Would you agree with that?
I would agree with that. I think the two things that are important now is the South American weather and what kind of crops they're going to have. 2 years ago they had droughts. Last year they had record crops. So how do they fall into that type of scenario? But most importantly is the seasonal trades. I mean, usually we make October lows. We rally into January based on South American weather. If everything's okay, we make February lows, and then we rally into May for uncertain weather. And I think that'll be the trend this year.
Let's turn to the financials. Alan, at last Wednesday's FOMC meeting, most Fed officials said they see gradual increases in the Fed funds rate, including one more hike in 2017. What are your feelings about this?
Well, I think that is very correct. We will probably see one more rate increase this year, most likely at the December 13th meeting. But I think it's not so much because the U.S. economy is improving to that point, although it is improving. I think it's more of a case where other central banks around the world, such as the Bank of England, is going to raise rates probably in the first quarter of next year. Also, it appears that the European Central Bank will start backing away from its quantitative easing program, which raises rates. So there are external factors which are putting pressure on the Fed to increase rates sooner rather than later.
Alan, gold, from early July until just about a week ago, gold rallied $152. Since then, the gold market has given back about a third of those gains. What is the outlook for gold now?
Well, some of the pressure is due to flight to quality longs being liquidated with an apparent somewhat easing of tensions with North Korea. Also, the probability of a rate increase at the December meeting, a bit of a bearish factor. But now that we have a lot of these longs taken out of the market and the recent Fed meeting out of the way, I think we can start looking again toward inflation. So I think we are going to build a base here. Ultimately, we will work higher, and I think there's a very good chance that we could take out that 1375 chart objective in the gold market.
Let's talk stocks. The indexes initially declined when the slightly hawkish FOMC statement was released. There was a dramatic recovery, however, later in the day, taking the S&P 500 and Dow futures to historical highs. What does this bullish reaction to bearish news say about stock index futures?
Well, the rule of thumb is anytime there is bearish news and a market can advance, and especially this time with the new historical highs on the very same day we had bearish news, that has to be viewed as a sign of strength. So nothing changing at all in our outlook for the indices. In fact, this is another bullish signal for stock index futures. So buy every break. There's a lot left price-wise and time-wise. And right now we're saying that we will see this bull market continuing through the end of this year, at least in all of the major stock index futures.
Thank you, gentlemen. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.